Aloha, fellow real estate nerds. I've been gone for a couple of weeks, and now I'm back to give you the latest and greatest Gig Harbor market data. Well, and Washington too. That's what we're going to be talking about, is Western Washington specifically. We'll go through the latest and greatest numbers because they're hot off the press, I guess, yesterday. So it's good to be back, get into the nitty gritty of things. I missed working, really. Chasing kids around the beach can be exhausting. I mean, you go on vacation and you're like, I need a vacation for my vacation. It's not the same going, like, you know, just as a couple or by yourself. It's a little different. Anyway, I'm ready to get back into it, and let's dig right into the data and see what's been happening in our local markets. For this week's market update, we're going to be looking at Matthew Gardner's Q3 report for Western Washington. Here, I'll pull it up on the screen here in 1 second. So Matthew Gardner is Windermere's chief economist, and he does these quarterly updates on, well, all of the markets that Windermere operates in. I think that's all Western states, mountain states, and Alaska and Hawaii. So if you're interested in those markets, you just you click on market news, I guess, and it'll take you there. And these are just the latest ones. So the other ones that he's done is Southern and Central Oregon, Northern, other parts of Oregon, other parts of Washington, Arizona, Northern California. So he's got got a bunch of data, but because we're in Gig Harbor here, we're more interested in what's happening here in Western Washington. So he begins all of his reports with looking at the regional economic overview. So we're going to look at that as well because it's really interesting what's going on here. Anyway, let me just pause it, grab a cup of coffee, and then we'll digest this report together, give you the highlights as I literally highlighted it. So let me get my coffee refill and I'll be right back. All right, starting with regional economic overview. The pace of job growth continues to slow in Western Washington. The region added only less than 22,000 new positions over the last 1 year. This represents a growth rate of 1.4%, which is the lowest pace of new jobs added since the pandemic ended. And that probably has to do with the fact that people have finally run out of savings and they had to now go back into the workforce, and also that there were a huge amount of layoffs that happened during the pandemic. All the businesses that went under, and they just had to, businesses had to downsize. Yeah, I think all those people finally have re-entered the workforce, and it's just, we're kind of getting onto the median trend line, for lack of a better way words. So I think that's just what's happened. It's not the region slowing down in economic terms, but rather than we're just coming out of the pandemic in terms of, slow data coming in, right? The region unemployment rate was 5.8%, which was marginally below 6% we saw last year at this time, so not much change there. A few smaller counties lost jobs over the past 12 months. King County rose a meager 0.4%, and that's mainly due to the job loss in the tech sector that we covered before. And then Matthew Gardner says he's not convinced that the U.S. is going to enter recession. He stands by that theory. I don't quite stand by that theory. But he says slowing job growth does not necessarily need to be precursor to a recession. I agree with that. That's the fact that I just explained. But he says, I expect that we will see lackluster growth until next spring at the earliest. And that's, well, we're in the winter months now, and not a lot of activity happens there, especially so many people, take time off, holidays and all that stuff. Especially people waiting for bonuses too. We see a lot of turnover after the bonuses get paid out. Okay, so that does it for economic overview. Let's go into Western Washington home sales. All right, let's read about all the exciting stuff happening here. It says in the third quarter of 2023, so that's this quarter, 15,000 homes were sold. That's nothing. Well, we're taking the fact that, this is the Puget Sound region, this is Western Washington. This is down 22% from the third quarter of last year, and it's 1% lower than last quarter. So not much change between quarter to quarter, but from last year, that's a huge change, 22%. Sales fell even as the number of homes increased. So the amount of homes for sale increased by almost 30% from quarter over quarter. This is clearly a sign so he's saying that mortgage rates are having an impact on the market. Who would have thought? Considering that, 70% of people use mortgages to buy homes. All right. Sales fell in all counties except San Juan compared to the quarter of last year. They were up in, okay, so we don't go care about it. But this is basically, this graph right here shows what's happened year over year. San Juan up, and the rest of rest of the counties are down. So here in Pierce County, we're almost down 25%. King County, negative 21%, and Kitsap almost down 30%. So that's quite the reduction in sales by county. So that's basically the big takeaway is sales are down. Prices, another big one that people are always interested in. Prices rose 2.8% compared to the third quarter of last year, and we're up almost 1% if we round up, higher than the last quarter, so 0.6%. The average home sale was, let's say, 775,000, and it's that high because most of the single-family housing stock is in King County, I'd say. So the fact there's so much tech and employment there in King County, so we have the major regions around there, Bellevue and Kirkland, Issaquah, all those places, Seattle. A lot of single-family houses. It's a lot different than other cities around the U.S. There's a lot more multifamily, so King County does have a lot of single-family housing stock, driving that price high, much higher than you see in Clallam, Jefferson, Grays Harbor, Lewis, or Thurston, or Kitsap, or Skagit, or Wacom. So that's just this is basically for King County the median sales price, really, and then dragged a little bit lower by the rest of the counties. Okay, we don't care about that. Okay, compared to the prior year, the pace of price growth has slowed in the third quarter. We said this isn't too surprising given the market was coming off record high prices in summer of last year. But what is surprising was that prices rose over the previous quarter, despite the fact that mortgage rates were over 7% for almost the entire quarter. So he's surprised at the fact that interest rates were so high and we still came up in price quarter over quarter. All right, and he says, I don't expect prices to move far from current levels in the coming months. Well, it's also the winter months. So yeah, I agree. And they likely won't rise again until after mortgage rates start to fall, which also I agree with, but he expects rates to fall sooner than I do. When prices do rise, I anticipate the pace of growth will be far more modest than we have become accustomed to. That's also true, I think. We had the decade's worth of price growth over the COVID pandemic. So I think that was like the leap for those 2 years were the leap for the whole decade. And now we're just going to kind of taper off as our inflation, the trend line of inflation and home prices. So we can pretend this is inflation and home prices did this, and then they're going to come over flat to meet inflation. That's basically the best way to explain that. And that also has to do with the fact that we have still inflation and all that jazz that'll bring nominal prices and real prices are kind of distorted right now, but inflation will bring prices down, even though prices might remain flat. Purchasing power. I'll explain that later. Okay, so this is annual change in home sales by county. So more home sales in Island, San Juan and Lewis. Kitsap was up. King County was up in home sales. Pierce, flat. So those are our local markets here. Okay, now for mortgage rates, this is Matthew writing. He says mortgage rates continued trending higher in this quarter, and are now not at levels that we've not seen since the fall of 2000. Mortgage rates are tied to the interest rates on the 10-year Treasury, and they move in the opposite direction of the economy. That requires a little bit more explanation. I mean, even in 2010, 11, and 12, the economy was in the toilet, let's say, and interest rates were low. But there was a tight lending policy, so a lot of people actually got turned down for loans, even though they wanted to buy houses with low interest rates. So there were low interest rates, and it was a really bad economy. So maybe you can say having low interest rates was an indicator the economy will improve eventually. So I guess we can extrapolate that there is a year, 2 or 3 lag on interest rates, and if they impact the economy, which makes us a little noodle, like, all right, if interest rates are high for us, let's say, even though they're at historical norms, we can see a recession in 2 or 3 years just because of the fact that there is such a lag time between economic policy and actual an effect on the economy. So, all right, I digress. Given the current position of the Federal Reserve, which intends to keep rates higher for longer, it's unlikely that homebuyers will get much reprieve when it comes to borrowing costs anytime soon. I agree with that. That's the Fed statement. And it looks like even though if they do pause, it's going to keep higher for longer just to see if they break anything. And if they don't break anything, they might continue to raise it depending what inflation does. So, yeah. And I'll talk about, I'll talk about it next year. So Matthew writes that I had to revise my forecast yet again. I now believe rates will hold at current levels before starting to trend down in the spring of next year. So he's expecting those green bars here. You see my screen. Let me zoom in. So he's expecting 7, 6.25, 6.5, 6.2% over the next year. the only way that I could see interest rates coming down that much is if something breaks in the economy. And if we look at historical data, I've covered this in recent, at least I think last month or the month prior, that the only time interest rates go down is when something breaks, and they come down quickly. So they come down much quicker than I think that he would be forecasting. So I think the 7% would probably be pulled out, or might hover around 7, a little bit higher than that, and not go down to 6. I don't think, maybe high 6s, but definitely not low 6s. So that's look for a different video. It was probably 2 or 3 videos ago that you'd find that. All right. With that said, let's look at Western Washington days on market. So it took an average of just a little over a month for homes to sell in this quarter of this year. It was 8 more days than last year at the same time, but 3 fewer days compared to last quarter. So not much difference, but quite a substantial difference from last year. Well, that's not surprisingly, since interest rates. Okay. Snohomish and King counties were the tightest markets, with only 19 days to find a buyer to put the house under contract. So here we can see the graph. Snohomish and King 19, Pierce County 23, so just a few more days on top of that. And then the rest that we're not interested in because they were not really next to them. So Kitsap and Pierce, yeah, pretty neck and neck. So interesting. Okay, now so these are his conclusions, and then I'll give my 2 cents on this. So this is his speedometer. I use it on every market report. Basically, it shows if we're in a buyer's market, balanced market, or seller's market. So spoiler alert, he still thinks we're in a seller's market, just slightly. But he says he might revise that in the next quarter as we do enter the winter months. Okay, so he writes, although it was good that listing activity rose in third quarter, it still remains well below levels that can be considered normal. So here, this is great data. 86% of Washington homeowners with mortgages have an interest rate below 5%, and more than a quarter have rates below 3%. Amazing. There's a little incentive for them to sell if they don't have to. Okay, and then he says, the disconnect between what homeowners believe their homes are worth and what buyers can afford with mortgage rates in the mid-7s for him is staggering. It's overwhelming. Most sellers appear to be getting their asking prices or very close to it, which reflects their confidence in the market. However, homeowners are being squeezed by multi-decade high borrowing costs. This is quite a quandary. However, taking all the factors into consideration, sellers still have the upper hand, but it's not enough to move the needle from the position I put it in last quarter. And then he writes, the market is still heavily favors sellers, but if rates rise much further, headwinds will likely increase. So that's it. That's his thoughts. So I think I called them head scratchers in my email. Let me pull up my email real quick. So he, what is head scratchers? Yeah, so those are his head scratchers. So he doesn't quite understand where we're going to go from here. It is going to be a cyclical market. We're going to continue to slow down. But after that, it's really, really up to the Federal Reserve what's going to be happening with interest rates. At least they'll be, somewhat stable for now, assuming the risk premium doesn't go through the roof. So we can consider those. All right, my 2 pennies. The first paragraph I already talked about is basically saying the Fed's monetary policy is going to be now of a wait and see what we've done, because I read, I think, Jerome Powell's last statement from the Jackson Hole meeting. He said, we're navigating by the stars on a cloudy night. So I think the Fed is just going to be pausing here for a moment and seeing what they've done. And if inflation continues to plague them, they might raise rates accordingly. But I think they're going to just kind of take a wait and see approach for now, but they will keep rates high. So I agree with him for that fact. But I don't agree, again, with the fact that he expects that rates to go down, because I've shown historically that the only time the Fed really brings rates down is because of the economy being in trouble, and they're trying to encourage lending. By encouraging lending, they're encouraging growth. However, that's not always immediate, because banks don't want to lend on falling assets. So that's just that first paragraph. The next paragraph, I talk about so there's two real estate markets. You got the commercial real estate market, and then you get the residential real estate market. So the people really feeling the pinch right now due to interest rates is the investors, flippers, developers and the syndications. They're the ones who usually get floating rates, or they didn't lock in any of their loans, and now they're all kind of feeling the pinch as their loans reset to higher interest rates. And so people actually are writing checks to get rid of property, is the best way to say it. So their debt service is exceeding what they expected, so their return on investment is lower than they want, so that might make them say, okay, let's sell this property and put that money into a risk-free treasury instead. Or they're being squeezed into selling their properties just because, well, they have to and they can't afford to operate as a loss. So, I mean, we've seen this in the office sector already. That's been making headlines, is that office have dropped in valuations because a lot of businesses don't need as much office space anymore, especially with a lot of companies keeping their work from home policy, or keeping at least a partial or part-time work from home policy. This means we can do a lot more hoteling in office space. So you can hoteling in office spaces, which is you have fixed desks and you have employees that kind of rotate in those same desks, meaning you can have a lot smaller office. A lot of regional banks are exposed to these falling values, and so we're going to see what's going to be happening to the regional banks as they are forced to repossess those or sell those loans onto other entities at a loss. So from the article that I linked here, it's a Reuters article, a weak demand for office could trigger a wave of borrowers to default on their loans and put pressure on banks and other lenders, which are hoping to avoid selling loans at significant discounts. Okay, that's what I just said. Okay. So what's been happening to banks? Well, they see the writing on the wall and they have tightened their lending standards. So it's not even, let's even take interest rates out of this. All they're seeing is a lot more risk to lending right now. And that's because they need to get paid back, and they need to have the valuation on what they think something's worth, especially when a property is falling in value. The cap rate goes up and the valuation for that building then goes down, which means that their debt service is far higher than it needs to be. I don't know, I'm getting into the weeds here. Let me just say they're increasing their standards, meaning they want a lot more down on a property, and they want a lot more collateral. So it's the bank would say, hey, we need $2 million in this bucket as part of the loan agreement here. So this translates to a slowdown in development. So this increases or decreases the amount of housing. So it's increasing the housing shortage because people aren't developing any more additional housing. This coupled with home buyers having to rent now, would-be home buyers rather, because they have to rent instead of buy because they just can't afford to buy. This puts upward pressure on rents, especially over the next few years. Rents are lagging housing prices. They are, renewed largely year over year. So we will see rents continue to tick up, which means more pinch on people's pockets, especially during a recession. And then I'll finish this off with saying there will undoubtedly be blood in the commercial real estate water. Single family housing is completely separated from this and will likely remain flat, and it will go down in terms of inflation, so purchasing power. So if your house is worth $1 million today and it's worth $1 million in 3 years from now, it will have gone down in purchasing power due to inflation eating away the purchasing power of that equivalent of $1 million. And coupled with negligible price growth, so it might be $1 million, might be $1 million, $1,002,000, let's say. That's negligible price growth. So it'll, it's normal. I think we've seen that. I talked about this. The run up in during the COVID times is basically a lot of appreciation at the beginning of that 10-year or the decade, and then it'll just flatline for the rest of the decade. So that'll bring us closer to historic price growth. So we won't necessarily come down and crash like 2008. It might just be, flatlining until we reach that pivot point again. The only real threat, I think, to housing, this is the most probably the important point, is the fact that we do have low supply, and people see that as like a bullish signal, saying, oh, we have low supply. This means that sellers can really keep prices high. Well, what that also means is the way that real estate works is a lot of real estate is priced by comparables. Now, when you have low inventory, this means you also have a low amount of comparables. So as I say here, meaning in the event of a recession, a sudden cohort of homeowners, let's say the first 3 months of recession, might just push a lot of homes for sale, and people need to sell those quickly. That might bring prices set the beginning of prices coming down. So when a real estate agent prices a home, they use comps, especially over the past 3 months. And those are the most important comps to look at. So if they look at comps and the comps are going down in price, that might just be negative feedback loop as people are like, okay, the market's going down. When in actuality, it was, a few homeowners or the cohort of homeowners that got either moved or fired or laid off or what have you, that needed to sell. So since real estate is a slow moving market and trends take a while to be seen in data, and we probably won't see that for a while, but that is a definite threat in a low inventory environment, is that, a few bad apples can spoil a bunch, let's say. So anyway, without further ado, that was a long one. That was probably longer than actually reading it yourself, but I thought it was important to get my thoughts out there, even if I did stumble through them a little bit there. Kind of out of practice over the last 2 weeks, but that's it, and I hope you learned something. Hope you agreed with me, or you didn't agree with me. You're welcome to write your thoughts in the comment section down below. That's what it's for, and I will reply to you. I'll be coming to you again in November. We're going to be looking at November data. It's been great. It's going to be depressing, and I'll see you then, especially probably raining too. All right, till next week. See you later.